Hi everyone, Caroline here. First live session, so would love to know who's here. Of course, I can't see you, so what would be fantastic if you, particularly if you're one of our existing clients, just put your name in the comment, and just so it'd be great to sort of see who's here. Also, if you have any questions along the way, please put them in the comments, and I'll answer them as they come through. But I've just been reminded that if they want to, they need to click in the post you need to click in the post to allow it. Okay, it's coming up with Facebook user. Anyway, so I'll start with some of the questions. So what have we got? So essentially, the main sort of thing that I wanted to talk about today is what's happening with Corona at the moment, especially with markets. So what we've got here is, and some of you may have seen this slide already, but it's just a comparison in terms of what's happening at the moment in terms of Corona compared to what's happened in the past with the GFC. Now I'll make that a little bit bigger. And essentially it is different this time, but what's interesting is it's that we call it a black swan event. And what do we mean by a black swan event? Corona has never happened before. We've had other pandemics which have impacted the economy, but it hasn't been Corona before. And of course, the global financial crisis wasn't Corona. So how is this different? It's really looking at, it's a different cause in terms of the global financial crisis, which some of us may remember, was really a problem in the financial system and the banking system. What we've got at the moment is, because of this illness and because of the pandemic, we've got a lack of workers in the economy. So it's a different type of issue, but it's still what we call a black swan event. And what do we mean by a black swan event? Is something that's rare and unexpected. So although we haven't had something like Corona before, we have had other pandemics, and we have had large unexpected events which have had a really negative effect on the share market. So how is this different? It's not a crisis in the banking system, it's just a crisis in the labour market, given people have to stay home. So what will be interesting is what's going to happen in relation to Corona, and will we see an improvement in relation to share markets? And so what I wanted to sort of show here is what sort of happens with the market cycle, and sort of talk about the 4 stages of a bear market. So in relation to the four stages, we've gone sort of through the first stage of recognition. We had an 11% drop in share markets in the last week of February, and that was a sort of a big sort of, okay, something's happening here now. Then, of course, there was the panic, and sort of share markets have sort of gone down 30% around the world, not just in Australia. What we're starting to see, but you never know until you're on the other side of it, is stabilisation. And what does that mean? That markets are sort of now bouncing around a certain level. We've seen some increases, so they've sort of come off their current bottoms. That's not to say that they won't go down again, but they're sort of bouncing around, and they're a little bit flat at the moment. They might go up or they might go down a little bit each day. So we're starting to see some stabilisation, and that's also starting to happen because people are getting used to it. In terms of, this is now becoming, normal, in terms of people are settling into a new routine. No one wants this to stay, of course, but people are starting to settle into a routine. People are working from home, communicating online like we are now. But also the worst potentially is over. So, and what we're sort of starting to see in some countries is the numbers of infections decreasing. And when the market starts to see that, that's the 4th stage, which is anticipation, when markets start to increase. So we've had some panic buying already, and this is sort of with these 4 stages in terms of the uncertainty was where we were at in late February. Then we've sort of seen the panic selling that was happening in March. And what I expect to see sort of going forward is people taking advantage of such low markets and potentially having a benefit. The problem is we never know when this stabilization has happened and the anticipation until after the event. So there's a great story in terms of March 2009, which was the worst of the global financial crisis. And one of the well-known investor conferences in the US, and there was a keynote speaker talking how he was predicting that in March 2009, share markets were going to stay in losses for quite a few months to come. And the very next day, the rally started. So even professionals don't know what's necessarily going to happen the next day. And so this leads into the next couple of questions that people had in terms of why shouldn't you sell the investments to cash, just given there's so much uncertainty. And the problem is it's short-term uncertainty. No one knows when markets are going to rally, and the previous example was a perfect example in terms of even the professionals don't know when things are going to return. And so you also, even if you get the timing right in terms of selling and you just get lucky in terms of if you happen to sell in February, you don't know when is going to be the right time to buy back in. So it's one thing to sell based on short-term uncertainty, but at what point in time do you buy back into the market? And as we've already said, no one knows when the bottom is going to be until after you've hit the actual bottom. So particularly for our clients, we recommend that if you need the money within sort of 12 months, you shouldn't be investing anyway. If you know that there's a particular goal that you're saving the money for, and that goal is within 12 months, you should really be holding on to that cash. And it should just be sitting in a very secure bank account. So if anyone is sort of more of a long-term investor, and we're sort of talking 3 to 5 years plus, then you've actually got time to wait this out. You actually don't need to access that money short-term. And in fact, it just becomes a buying opportunity. And for those, and we've had a few meetings with some of our existing clients in relation to if you're living off the income, then if you're living off the investment portfolio, then that's what's most important at this point in time. As long as the income is stable, which it currently is, although we may see a decrease in the dividend payout ratio, but that's to be expected given dividend payout ratios are quite high anyway, then you just continue to receive your income and you just sort of weather the storm. But it also goes back to sort of diversification and what sort of having a mix of investments. So when going online to Summerhill Invest and sort of doing your online questionnaire, you are asked a series of questions about your tolerance to risk. And this is to make sure that you have a portfolio that's recommended to you that gives you that sleep at night factor, that you're not waking up at 2 o'clock in the morning worried about what your portfolio is going to do. So getting that right mix between, okay, how much should I have in shares and how much should I have in bonds, which behave a little bit differently to shares, as we've sort of gone through in the Summerhill Invest community Facebook group. Getting that mix is incredibly important, particularly during periods like this. So many people find bonds and cash very unsexy investments. When markets are doing very, very well, they're very, very boring because you don't buy cash and bonds for their investment return. You buy cash and bonds where you hold cash and bonds for the security and the dampening of volatility in the portfolio. So particularly if you've sort of gone through your working life and you're much more focused about preserving your capital, then not all of your wealth should be in shares anyway. So you'll have that sort of balance. Whereas if you've got many years to go and you're going to be earning income for quite a period of time, you're actually a buyer of share markets. So the share market's on sale. And so for those people, in terms of if you are buying and you've got money to invest, even if it's a small monthly savings plan, the lower the market is, the more you get in terms of your monthly savings plan or the amount that you're investing. So if we use an example of, you've got $100 per month savings plan, in terms of the number of units in the ETFs that you can buy, of course, you can buy more units in an ETF when the share price or the ETF unit price is lower. So it's actually in your interest as a buyer, or the technical term wealth accumulator. You're accumulating wealth. It's actually in your interest to keep markets as low as possible, which can be a little bit confusing because, of course, everyone wants to see markets increase. But from a long-term capital gain point of view, it's actually much more, gives you that longer-term capital gain benefit by having the markets lower. So in terms of one of the questions that we received is, should I invest now or should I wait? And this is going to depend partly on your appetite for risk. So how comfortable are you with investment markets? Me personally, I've invested some money in the last 2 weeks. Given even if this volatility continues for another 6 months or so, I know I have absolute confidence that markets will increase, and I have absolute confidence that markets are cheap right now. So I'm comfortable buying now. And also, even just from an income point of view, as we mentioned before, the companies in these shares are still paying very healthy dividends, particularly from an Australian share point of view. I'm much better off waiting through some volatile investment markets, but getting my dividends coming through as income, rather than just having money sitting in the bank account earning interest. But I'm comfortable with investment markets and I have that confidence. If you're a brand new investor, you've got a couple of options. You can wait it out, but by the time you're ready, maybe the investment market or the share market has increased a little bit, and this is just a payoff, or this is just a cost benefit that you need to work out what's right for you. If you're willing to give up some potential return, but knowing that you'd rather have things a little bit more secure right now, then that's particularly fine, and you should be doing something that's right for you. Another alternative, and we've sort of discussed this just recently in the Facebook group, is dollar cost averaging. So if you're a new investor and you're thinking about starting, you can actually just look at starting, rather than investing all of your savings in the investment portfolio, is maybe invest over a 3, 4, or even a 5-month period, and just invest a little bit each month, which then just averages out your average unit price. So if you average it out over the next, let's say, 6 months, just to make it easy. And in fact, we might just go back here to make this a little bit easy, just to talk about ETFs. So if you're buying an ETF over the next 6 months, and let's say you've got 10,000 to invest, let's say you just want to start off with 1,000 each month, then if the share market goes down, and in fact, I might just go with this one. So if the share market goes down, you're actually getting the benefit of that share market going down because you're investing another 1,000 euro each month. However, if we have reached the bottom and no one knows, and share markets start going upwards, then you're actually the dollar cost averaging is a safer approach, but it could mean that you're actually just buying in at a high unit price each time. So there's really no right or wrong. It really depends on how comfortable you personally are with investment markets. But this also comes back to when you sort of go on to Summerhill Invest and sort of do your online questionnaire, it really helps work out which is the right portfolio for you based on getting that mix of share and bond investments. Now, one of the other questions we had was, does market timing ever work? Now, for sure, market timing can work, but it's generally by accident rather than experience or skill. So my theory is share markets are based on news and events. So what's happening with NAB or ANZ or BHP, it's all based on news and events. And those news and events may be based on global news and events. They may be based on Australian news and events, or they may be based on company news and events, something that's happening in that particular industry or that company. No one can predict what's going to happen tomorrow, next week, or next year. So you can't predict share prices. For sure, there are always people that say, oh, I knew this was coming and I sold out or I did something. And for sure, if they get it right, then they'll tell everyone. If they get it right, they tell no one. So it's human nature to talk about our successes, not our losses. But speaking to various stockbrokers and speaking to various clients over the years, market timing is not something that works consistently. Maybe you get it right, but more often than not, you'll get it wrong. And this is why we're big believers in not selling investments based on short-term uncertainty. What we might look at doing, or what we consider doing, is maybe looking at valuations. That's different. If we look at a valuation to say, okay, this market's particularly expensive, maybe we start to look at reducing exposure there. But I'm not a great believer in market timing at all. And this is one of the benefits of ETFs as well. ETFs provide, and this is why we use ETFs and sort of index passive investments for all of our clients, in terms of they help with the diversification. So you're actually taking out market timing not only from what's going to happen to the total share market tomorrow, next week, or next year, but also taking away the risk of what's going to happen to this particular stock or what's going to happen to this particular industry. By buying up the whole market using ETFs and buying up different markets, you're actually sort of taking away that aspect of trying to time the market in terms of what's going to happen to the banking industry or the car industry. So one of the other questions we received is, what is a risky investment, and is investing risky? Now, there's a couple of ways that you can actually answer this question. Investing can be risky depending on how it's done, but not investing is also risky. So I'll start with the not investing first. So I'm a great believer in investment, and the whole purpose of investing is to achieve your goals, regardless of what those lifestyle goals are. That is why we bother with getting advice, making the effort in terms of investing. So not investing and leaving money sitting in a bank account not earning very much, I think, is a risk, especially if it means that you're not going to achieve what you want to achieve in life. For sure, investing, there is an element of risk with investing, and this is, again, why we have the diversified portfolios. When many people try and invest by themselves, they might just buy one ETF, and then they're sort of putting all of their eggs in one basket, so to speak. So again, by going sort of online and doing this risk tolerance questionnaire, you can actually manage the risk by having the right mix of investments in terms of the right mix of shares versus bonds, and then within each of those, having a good mix of corporate bonds as well as government bonds, as well as various companies in different industries, as well as different geographical locations. So, and of course, shares has a high level of risk because they're more volatile than, say, bonds, which don't move as much in value. So investing can be risky, but you can do things to manage that risk. And this is how we've built Summerhill Invest, to try and manage that risk for our clients as much as possible. So you're only taking on the risk that you get rewarded for. For sure, shares will give you a higher return than bonds over time, but they have a higher risk than bonds, but you get rewarded for that risk over time. So we just believe in not taking any risk that you don't get paid for, so to speak. One of the next questions that has come through is, how much should I save each month, and why should I have a monthly savings plan? This is a topic that we've covered in our Facebook group as well, in a post from a little while ago. There's no fast rule of thumb in terms of how much you should be saving each month. Generally, what I do recommend, though, is what we call the 50-30-20 rule. And essentially what that means is 50% of your after-tax income should be allocated to needs. So all the things that you have to pay for in relation to just living. So the cost of your home, groceries, the electricity bill, the cost of running the car. So 50% of your income are those expenses that you just have to incur. We sort of say 30% expense, or 30% of your after-tax income, to the wants, to the nice to haves, the little things that we're actually all doing without at the moment, in terms of going to restaurants, travel, going to the movies, all of those things that make life fun and interesting. So we're actually in an interesting time for those of us who are still working and still receiving an income. We're probably actually saving a fair bit, so we're probably not spending that 30% allocation at the moment. Then the remaining 20% is allocated towards savings. Now, that may be to superannuation, or it may be to an investment portfolio, but the real goal would be to save 20% of your after-tax income to your goals, to a long-term investment plan, superannuation plan, whatever it is that's for savings. And the reason why we recommend a monthly savings plan is because it's a lot easier than keeping a budget. I'm not a fan of budgets. No one likes to feel restricted. And I think what we're all going through at the moment is a really good example of that. Me personally, I'm getting really grumpy in terms of social isolation and just sort of staying at home all the time and not sort of being able to do very much. So no one likes to feel restricted. So no one wants to feel like, you can only spend $10 a day on lunch and no more. So what I recommend instead is look at this 20%, work out what your 20% is, and then allocate that to an investment plan. And that can just be automatically taken out of your account, direct debit into your savings plan, investment plan, or whatever. You don't have to worry about it. It happens automatically. And I will guarantee that when it's not there, you will barely even notice it. We generally find with all of our clients, no matter what our clients earn, when we have this automatic savings plan in place and the money's not there, people adapt. And so it just becomes an automatic habit that you just don't spend what's not in your bank account. Rebalancing is something that's really topical at the moment in terms of, so the question we received is, what is rebalancing and why is it important? So rebalancing is when you have a portfolio, and let's say you start with a portfolio that's 50% shares and 50% bonds. And let's say we've got the situation at the moment whereby you started off with this 50-50 portfolio. You invest now, so you're a new investor, and let's say you invest $10,000. And in 12 months' time, let's say share markets do quite well over the next 12 months, given they're coming off a very low base. That portfolio has now grown to, let's say, $13,000, but your share component is now 60% or 65% of the total portfolio. So you've gone out of whack with this 50-50 portfolio, which is what you are most comfortable with. So when you rebalance, essentially what the portfolio does, and this is what, again, we've built into Summerhill Invest, it automatically sells what is overweight, so in this example, shares, and then buys what's underweight, in this example, bonds, and gets you back to this 50-50 split. Now, the benefit of that is if shares do really well, it realizes the capital gains and invests something back into what was underweight to get you back to that 50-50. But similarly, let's say you invested $10,000 exactly a year ago. Of course, markets have gone down given where we are. The bonds would be sold because they reflect more than 50% of the portfolio now, given the shares have gone down so much in value. Bonds would be sold and shares would be purchased as part of this automatic rebalancing. So you're buying shares at a much lower cost. And so that's how rebalancing works. As you can see, it has this extra effect of not only just keeping you in balance with your portfolio, but has another benefit of buying shares cheaply or selling them when they get a little bit, when you've made some gains, to get back into balance. In relation to something else that I just wanted to go through, this is something that I came across. I've just realized I haven't been changing the banners. My apologies. Everyone knows that this is the first time I talk too much and I haven't been paying attention to the software. But this is a slide that I wanted to share with you, something that I sort of came across. And it's a comparison of where we are now during the corona crisis in 2020 compared to where we were up to at the same time with global financial crisis. And I think it's just an interesting slide in relation to the orange, of course, is the global financial crisis, which continued on for about 3 years or so. And the blue, of course, is what we're going through now. So it's quite similar in terms of what we've been going through, and including sort of, a jump up. So as we can sort of see, it's still quite volatile. So even though here we may have thought that we're at the bottom and then we started thinking that things improved, then the market, of course, went down again. And that still may happen with corona. The thing is, we just don't know. Things got a little bit worse after we thought they stabilized and then continued to grow. And of course, anyone that held their ground and stayed invested throughout the GFC did very, very well. And this is also where it comes back to having confidence, a little bit of courage, but also experience. Experience makes a really big difference for investors. And one of the sort of stories that I like to tell is during the global financial crisis, one of my oldest clients in terms of age, she was 75 back then. During the worst of the global financial crisis in March 2009, she was my most aggressive client in terms of wanting to invest. And that's because she'd been through it all before. She'd been through the 87 crash in terms of Black Monday. So she'd been sort of through Black Monday. She'd been through even back in the early 70s when there was an oil crisis. And so she had absolute confidence that markets would increase again. What we all just don't know, and what's causing the uncertainty, is we don't know when that will be. We don't know if that's going to be in a month, 6 months, or 12 months. And this is what's sort of driving the uncertainty at the moment. As soon as markets start to see light at the end of the tunnel, markets will improve. Going back to what we talked about in terms of the 4 stages of a bear market, with that 4th stage being anticipation. As soon as markets start to anticipate an improvement, the market is always looking forward, never backwards. So as soon as there's anticipation and light at the end of the tunnel, we will start to see markets increase again. We just don't know when that will be. That's all the comments that have, all the questions that have come through today. Thank you for bearing with me in relation to working out the software, and I must remember next time to change those banners. Again, once I get talking, I tend to talk a lot, as many existing clients know. We will sort of be running this Q&A every week at the same time, just for a little bit of consistency. So please, would love to get any feedback that you had. Just post a comment in the feed, in the stream. Any feedback, any comments, and certainly over the next week, any other questions that you would like us to raise next week. A lot is happening every day, every week at the moment. So more than happy to answer any questions, either about what's happening at the moment in relation to Corona and the effect on markets, or just general investing and managing finance in general. Thanks for listening, and looking forward to seeing you next time. Bye-bye.